Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, aka Mr. Valuation. In today's video, we're going to talk about the sick managed healthcare companies and ask the question, have they found the cure or are they even curable? I'm going to look at 5 managed healthcare companies here, 4 very prominent ones and one that you may not have heard of. But I'm doing this just so I can contrast the industry. And then let's look to see what we believe the future might hold and why. So I've created a portfolio here, and as usual, I'm just going to go in alphabetical order. But looking at the portfolio headings, all of these are investment grade except Molina. This is the one I referred to earlier. It's a relatively small one. Has a current market cap of under $10 billion. UnitedHealth, of course, is the monster with $280 billion, and many consider it maybe the best in the industry, and it does have an A+ credit rating. But second would be Elevance with an A rating and over $71 billion, one of the largest Blue Cross Blue Shield insurers out there. And then there's Humana coming in at $36 billion, which is BBB, which is just a couple of notches short of an A rating. So all these companies are pretty good companies from a standpoint of credit rating and so on. They go from a small cap, small mid-cap Molina to a very large cap like UnitedHealthcare. 3 of them pay a dividend, with UnitedHealthcare currently paying the largest dividend. But as you'll see, that has mostly to do with valuation rather than high payout. And then earnings yield-wise, the best earnings yield would be Molina, okay? But it's the lower quality company. It does not even have an investment grade rating, okay? But the PE is under 10. The next best valuation would be Centene. It has a very high earnings yield, but as you're going to see, there's some issues with that. And one of the things I'm pointing out here, you just can't go by looking at raw statistics. The devil's always in the details, and that's why it's important to start by looking at a long-term fast graph, looking at what the analysts are forecasting, and then applying some continuous research and due diligence of your own to see what that's about. Now, before I show you these companies, I'm going to make a point. What has happened to all of these companies, it's really a kind of an industry-wide phenomenon, is most of these companies were really miscalculated their morbidity rates. In other words, the amount of sickness and claims that are going to be filed against them. And they have actuaries that calculate those things. That's how they price things and how they set their business models and their profits. And the morbidity rates came in way higher than they anticipated. And as you're going to see, that hurt earnings dramatically. So let's start by taking a look at Centene. All right, now one thing I want to do here that I'm going to do, we're going to go into the historical graph, and I'm going to take price off of the graph, and I'm going to take normal PE off of the graph. And I want to just look at these companies practically, okay? Centene had a very excellent record through 2024. Okay, and their earnings are expected to be down over 75%, 76% for this fiscal year end. And of course, that's just a little over a quarter away. All right, so we're getting towards the end of the year. This company had probably the most damage to their profitability of any of them. Now, analysts are expecting a recovery. And if I look at the analyst scorecard on the company, the analyst scorecard for this company has actually been pretty good until just very recently, just this last forecast. So when we look at the company, we can see that they had a very good earnings record. Now, this orange line is a PE ratio of 15 on a company that has a growth rate of 13.69%. Now, that growth is from here to here. Let me use the scroll bar and pull this back to where I get rid of these current years. And Centene had historically been growing at almost 18%, with one down year in 2012. And that's something to focus on here for a moment. But then they had some really incredible growth going forward, and again, until we hit 2024, and now we're expecting this big collapse in earnings. Now, as we bring monthly closing stock prices onto the equation, we see that price correlates pretty closely to earnings. Now, this is something I want you to understand. One of the things FastGraphs does for you, the orange line is drawn using a discounted cash flow based analysis or formula, okay? The only thing really different is we use the earnings yield of 6.67% or a PE of 15 as the discount rate, where academic discounted cash flow analysis and use treasury bill yields and things like that, what they call riskless investments. We're using a number that basically is the average valuation of stocks. And what it ends up doing is drawing these graphs where you have this thermostat, if you will, the orange line on the graph, that also offers a back test for you. One of the things that really chaps me is that your tool doesn't always work. It's not supposed to work. It's supposed to illustrate and define risk for you. That's what fast graphs are all about. Okay, and if you're looking at what the fair value of this stock would be based on widely accepted formulas for valuing a stock, and you see the stock trading above the orange line, that should be a red flag that the stock is trading at a high valuation. When the stock is trading below the orange line, those are optimum periods to pick up the stock because you're buying it below its intrinsic value. And you can see when it gets well above intrinsic value, this reversion to the mean. But look how different these are. The time frames, you can have high valuations last for a long time, and then you get these low valuations and they recover, and low valuations they recover. And of course, this is COVID, and this is the years following COVID, and yet we didn't really see the damage until 2024. But now you can clearly see how the price has tracked earnings, and it was in line with earnings based on what those earnings were. Now, if I take this chart forward and look at forward forecasts, analysts are expecting strong growth going forward. Now, be careful when you're looking at numbers, okay? 100% growth for 2026 over the 2025 number is really not a pure number because it's simply recovering from the negative. The company had this kind of earnings power prior to that. So it's now moving back toward this normal earnings power. But again, there's a lot of risk in this stock. Now, it has very manageable debt, and we can get into all that by going to things like fiscal fitness and look at things like returns on assets, which have been very good, but faltered a little bit for the first quarter of 2025. We can look at return on equity, same thing, and return on invested capital. The company normally has very strong numbers in those areas. And again, I'm not going to get too in-depth on each of these, but just point out to you that you can go deeper. Now, you can go into the summary page here on Fast Graphs and also get a nice profile of what the company is. Analysts had normally been accurate with this company, and based on the forecast, this could be a recoverable investment with a relatively high rate of return if the company were able to achieve these results that analysts are expecting. And keep in mind, this is more of a recovery period. Okay, but this stock is the one that I think has had the most broken earnings in the group. The next stock in the group is Elevance. Now, Elevance is actually one of my favorites. Again, once again, prior to what's happening now here in 2024, we had a little bit of weakness in 2023. And again, this company in 2023, they had 14% earnings growth. They're going to have no growth in 2024, and they're expected to have a negative 9% growth for 2025, which is the first down year. So here we have kind of flat growth. And the stock, again, really correlated to its earnings. And once again, this is a thermostat. This is a measuring device, a 15 PE ratio, a 6.67% earnings yield. Obviously, when the stock gets into high PEs, by the way, just because the stock has a high PE that's overvalued doesn't mean you can't make money. Up through August of 2024, you could have averaged about 12% a year if you bought it at this peak valuation here. But then through today's price, you'd still be generating a positive rate of return, but relatively weak. But here's the point I want to make. Take price off the graph, okay? And what you see here is a company that had some earnings issues, obviously, for these last couple years, but is expected to recover very quickly. They have very manageable debt. They're an A-rated stock. And I like this one the best out of the group because we're expecting about 9% growth, and that would indicate a 15 multiple as fair value, which means that there could be some really strong recovery short-term and mid-term, assuming they continue to hit these estimates. And now looking at some of the, since this is a dividend-paying stock, let's go ahead and look at it from a standpoint of operating cash flow. And we see significant operating cash flow forecast to cover the dividend. And if we look at it historically, we can see that their operating cash flow has covered their dividend, and their payout ratio has been very modest. We're looking at a number of like 9% of earnings have been paid out in that year. It's averaging about 25% in more recent years. Okay, so there's a lot of room for the dividend and the dividend to grow. From a free cash flow to equity standpoint, we also see a very positive chart. We see the fact that the company's generating free cash flow. So you're looking at a company with a strong balance sheet. You're looking at a company with manageable debt and good long-term growth potential. And you're looking at a company that basically has had a consistent sales record. What they haven't done well, which is true of all of these companies, and let's go look at margins, is what's happened is we're starting to see some weakness in the margins, especially the net margins down here, although they are improving now. And the beginning of improving is whether or not these companies are curable or not. And that was the thesis of this particular video. Are these companies turning themselves around? Elevance, in my view, has weathered the storm the best of the five, as you'll see as I go through these. So let's add the others real quickly now that you get the picture. Humana has actually been suffering earnings for the last 3 years, expected to recover. But again, when I put price on Elevance, you see high valuations happening when the company was performing well. And then you see this weakness in earnings has caused this correction as well as this volatility. And also notice, stock prices are totally erratic at times. And this idea that everybody is so focused on price, I focus on the business, the earnings of the company, and the dividends of the company. And it doesn't surprise me when I see the price react like this to when you have lagging earnings, like we saw with Humana. The next stock I'm going to look at is this Molina. And Molina is the small cap company. They've put together a pretty decent record recently. They did have a drop in earnings, and it's only a double B rated company. It's not even investment grade. Has decent amount of debt, doesn't pay a dividend, and the stock is starting to recover, but this was a strong reaction to one of the weakness in the earnings. And so these managed healthcare companies have been sick. UnitedHealthcare, and I like to look at this at a longer term perspective, UnitedHealthcare is the 800-pound gorilla, and they had almost a perfect record of growing at double-digit rates for years, and the market was putting a premium valuation since 2013 and 14, and I've talked about this a lot. The market has been putting very high valuations on these stocks during this period of time. Now, if I shorten the time frame, you can also see that earnings growth has been a little stronger during these time frames. All right, so that partially explains the higher valuations, but it still doesn't give the fact that the stock for most of this period was overvalued. And once again, when we see high valuations, we can see very poor performance in terms of stock movement, including dividend income. And this company also has good room to pay their dividend. But we see this poor performance really as a function of valuation, not earnings growth. Earnings grew 13%, 17%, 13%. And yet the stock did nothing during this period of time. And we can even carry this out here further, if you will, and move it out to where the end here, we end up having a 2% rate of return, including dividend income. So the bottom line is that earnings drive market price in the long run. Valuation creates a massive amount of risk so that even when companies are doing well, if you pay too much, you can have very poor results, even when the company is still doing well. But then you're very vulnerable to a headwind like we saw with the managed healthcare companies underestimating their morbidity rates dramatically. UnitedHealthcare had one of the more severe numbers with a 42% drop in earnings expected in 2025. Okay, so these are the five companies. And as I said, if I look at these five companies and I go strictly to forecasting on these five companies, we're not expecting any growth really out of UnitedHealthcare. I would consider it overvalued. And if you go out here to the end, you could actually lose money owning this if the market priced it at 11 multiple, which would be what a 1% grower would be. But if you priced it at a 15 multiple, which is approximately right here, you would only make 3.5%. So I don't consider UnitedHealthcare an especially good investment. Now, you can be misled by looking at the historical chart here. It's adding a growth rate that isn't really adjusted for what the growth is going to be going forward. But I also want to point out the only reason the growth rate is only 1% is because of the 41% drop in 2025. We're actually expecting about 8 or 9% in 2026 and 16% plus in 2027. But trading at a blended PE 15.49, and out here, again, we just don't have a lot of room to make a lot of money on UnitedHealthcare. All right, so let's go ahead and go up the ladder. Molina is expected to grow about 8.5 to 8.66%. That gives it a 15 fair value. If it earned those numbers and paid no dividend, you could make 35% annually on this stock. But I would consider this the riskiest bet of the group. The next one we go to is Humana. Humana is still facing what looks to be like some bad years going forward, according to the analysts. And there are 25 analysts that follow the company, and they've been steadily decreasing the earnings estimates. So this one, it looks like a reasonable company. If we look at the analyst scorecard, it's not bad. It's pretty good, actually, on a 1 year, and even a little better on a 2 year. But the point is, we don't see a lot happening. If we go all the way out here 2.5 years, you're still only looking at 2.5%. So Humana is off the table, for me at least, and it doesn't offer us much in the way of income. Now, Elevance is expected to grow at about 9% a year, and that would give us an opportunity to make almost 30% a year annualized as a function of the earnings growth, the dividend, which is over 2%, plus the PE ratio expanding from its current 10.4 out to a 15 PE. That all adds up to about a 29 to 30% annualized rate of return. Now, that may not be the highest number here. If you look at Centene, Centene stands to make about a 47% rate of return based on a recovery that I talked about earlier. But once again, this company pays no dividend. It's a BBB minus quality company with 39% debt, and it does offer the best rate of return, but I think risk adjusted, it still comes down to Elevance. I think Elevance is the best. But having said that, regardless, if you look at the whole group as a group, I do believe all these companies, I'm not so sure about Molina, are capable of righting the ship, of adjusting their morbidity actuarial assumptions and pricing themselves or running their businesses the way they should. Now, as always, you want to do further research on these companies, okay? So Elevance looks very intriguing, as I mentioned, from a standpoint of just looking at the numbers and looking at the fact that it weathered this storm better, so their actuaries had a better record than the rest of the companies. But then if I go looking at other services here, like if I go into Morningstar, Morningstar is giving this company a 4-star rating. Okay, I like that. And they're saying raising our uncertainty ratings on Cigna and Elevance on regulatory concerns. So there are still issues out here. And you can read the bulls and bears area here. It continues to use its scale. But the bears are worried about some risk as well. But the company did owe $30 billion in debt, a ratio of slightly above its target leverage of 40%, but it's still really very manageable in my opinion. Now, we can go through the same process and look at companies like Centene and start digging into, I'm just using Morningstar here as an example. This is how I'd go the process. They actually get a 5-star rating, and they're talking about fair value of $70 a share. If I looked at Fast Graphs, this would be $50 a share. This would be $73 a share. So we're not totally out of line with Morningstar in that regard. If I look at Humana and once again go into Morningstar, and I'm just using Morningstar as one example, I would go through a process. There's a lot of, Humana only gets a 3-star, which was kind of consistent with what I presented here. If we go and we look at UnitedHealthcare and go into Morningstar, UnitedHealthcare gets a 4-star rating. They get a fair value of 400. And again, the stock is trading at a value of 308, but 400 would be a little high based on what FastGraph sees, but I think they're giving it some quality there. So the bottom line is, it does look like these companies are recovering, and I do want to make a point. What they've run into here is a storm associated with COVID, Some argue it's the vaccine, some argue it's the disease itself, and some argue that there's just a lot of other reasons why things like cancer and cardiovascular diseases and so on have been rising so much. But the bottom line is they've got to adjust their actuarial assumptions on morbidity and price their products better. And I think all these companies are capable of doing that. The question is, how much risk do you want to take and what do you like? I like Elevance primarily on the fact that I felt like they went through with the best numbers during this crisis of any of them. Anyway, this is Chuck Carnevale. Thanks for watching. I hope you enjoyed this. Or have the sick managed care companies found the cure? We'll see in the future. Now, should notice that when I showed you those charts, most of these stocks are already recovering off of their lows. So there's still plenty of opportunity to invest in any of them, depending on your own goals, objectives, risk tolerances, and your own continuing research and diligence. If you liked the video, give me a like, ring the bell, subscribe to our YouTube channel, and most of all, take a look at Fast Graphs. What a powerful tool to help you make longer-term, prudent, and profitable decisions, and also a tool that can really help you manage risk. Thanks for watching.